Hi friend! In this video, I'm going to explain debits and credits in a way that actually makes sense. And I'm going to show you my #1 accounting hack called dealer. If you're a business owner using QuickBooks and you've ever thought, I don't really get debits and credits, but QuickBooks seems to handle it. Well, you're not wrong. But when something looks off, profit feels wrong, or something lands on the balance sheet instead of the profit and loss, this is where understanding the basics really helps. So let's break it down. First, let's talk about what debits and credits are not. Let's clear up the confusion first. Debits and credits are not good versus bad. They are not income versus expenses. And they are not pluses and minuses. They are simply the two sides of every money movement. In business, money never appears out of nowhere. If money goes into something, it must come from somewhere else. That's the entire idea behind debits and credits. This brings us to double entry accounting. Double entry accounting says every transaction must affect at least two accounts. Why? Because at any moment in time, your business must always satisfy this equation. Assets equals liabilities plus equity. This is called the accounting equation, and everything in QuickBooks is built on it. Let me explain this in plain English. An asset is something your business owns or controls that has value. Examples are your business bank account, cash, equipment, a vehicle, money customers owe you, or accounts receivable. A liability is money your business owes. Examples are credit cards, loans, unpaid bills or accounts payable, payroll taxes you haven't paid yet. Equity is the owner's stake in the business. It represents money you put into the business, money you take out, and profit that stays in the business. Think of equity as the owner's bucket. So the equation assets equals liabilities plus equity means this. Everything your business owns was funded either by debt or by the owner. So there are only two sources of money, the lenders and or the owners themselves. That's it. Let's say you buy a house for $500,000. You take out a $400,000 mortgage. That's a liability. You put down $100,000 from your own money. That's equity. So asset is the $500,000 house. Liability is the $400,000 loan. Equity is the $100,000 owner's stake. Businesses work the exact same way. All right. Before dealer makes sense, we have to slow down and talk about equity because this is where most people get stuck. When you look at your balance sheet and see the line equity, it feels vague, doesn't it? But equity is not just one thing. Think of equity as a container, and inside that container are three main pieces. So equity is made up of three things. First, owner money going in. This is money you, the business owner, put into the business. We can call this capital contributions or owner contributions or simply equity. Second, owner money coming out. This is what you take out. We can call this owner draws or dividends. This is where the business distributes funds back to its owners. Third, profit that stays in the business. This is your net income. So in plain English, equity is what you put in plus what the business earns minus what you take out. That's it. Let's break net income down one more level. Now here's the important part. Net income isn't mysterious either. Net income is just revenue minus expenses. That's your profit and loss statement, your income statement. So when your business earns revenue, that eventually flows into equity. When your business has expenses, that reduces net income, which also affects equity. This is why your profit and loss and balance sheet are connected. So let's plug in all these things into the equation. Assets equals liabilities plus equity or owner contributions minus dividends or owner draws or owner distributions plus revenue minus expenses. But here's the thing. Accountants don't like looking at equations with a mix of pluses and minuses all over the place. In math, when we want to show everything as positive numbers, we're allowed to move them from one side of the equation to the other. And when we do that, the sign changes. That's not accounting, that's just basic math. Let's do that step by step. Let me show you the math. Right now we have dividends and expenses subtracting on the right side. If I move dividends to the left side of the equation, it becomes positive. If I move expenses to the left side of the equation, it also becomes positive. So now the equation looks like this. Dividends plus expenses plus assets equals liabilities plus equity plus revenue. Nothing changed. We didn't invent anything. We just rearranged it so everything is positive. Now look at what just happened. On the left side, we have dividends or owner draws, expenses and assets, and that spells DEA. On the right side, we have liabilities, equity or owner contributions, and revenue. That spells LER. So now we have DEA equals LER. This is why dealer works. It's not a trick. It's not a mnemonic someone made up. It's simply the accounting equation fully expanded, then rearranged so everything is positive and each side balances cleanly. That's also why dividends or owner draws, expenses and assets behave similarly in accounting. They normally increase with debits. Liabilities, equity, and revenue behave similarly. They normally increase with credits. They're on opposite sides of the equation. So when QuickBooks asks you to categorize something, what it is really asking is, does this belong on the DEA side or does it belong on the LER side? Once you see that, debits and credits stop being mysterious. They're just keeping DEA and LER in balance. Now that you see where dealer actually comes from, let me show you how this plays out in a real QuickBooks example. Example 1. You, the business owner, transfer $5,000 from your personal account into your business. So what happens? The business bank account increases, that's an asset. Money that came from you increases, that's equity. So the equation stays balanced. Assets go up, equity or your contribution goes up as well. Nothing hits income, nothing hits expenses. That's why this shows on the balance sheet, not the profit and loss. Here's our second example. Your business borrows $1,000 from the bank. Cash increases, that's an asset. Loan increases, that's a liability. Assets go up, liabilities go up. Still balanced. Now, did you know QuickBooks is already applying debits and credits for you? Your job is simpler. Choose the right category. Understand where something belongs. When you understand dealer, your reports stop feeling random. So, my friend, you don't need to be an accountant to understand debits and credits. You don't need to memorize rules. You just need to ask, where did the money go? And where did it come from? That's debits and credits. If this helped, hit the like button and subscribe and let me know in the comments which one trips you up the most, assets, liabilities, or equity. I'm Catherine Silverio. If you're a business owner and you need help with bookkeeping, call, text, or email to schedule a free discovery call. And if you're not ready to leave yet, I've got another QuickBooks video waiting for you right here.